Hi everyone, my name is Bharat. I'm very excited to invite and welcome all of you to our fourth edition of Future of High Tech. This is a series where we talk about all things related to high tech. Today is a very interesting topic. SPACs, not so much new, but they have become the rage in the high tech. And today I have two of my dear friends, Ben and Niccolo, talking about this very topic with you. Niccolo happens to be the force behind one of the best performing SPACs. I wish I had invested more. A little bit about Ben, and then I'll ask Ben to introduce Niccolo. Ben leads our CMT practice, is a board member at Carney. He's had a long journey, started at Carney, went to the White House, started some companies, became a VC, I guess got bored playing a lot of video games, came back to Carney, and now is a board member and also leads our CMT practice. I think Ben brings a very interesting perspective to this, both from a startup policy investing perspective, and I'm going to ask Ben to actually introduce Niccolo. Just a quick housekeeping. Please send your questions through chat, and we'll take them throughout the conversation. Let's make it more of a conversation than just a discussion. So Ben, with this, I'm going to ask you to welcome Niccolo, as well as welcome you too.
Sure. It's great to have Niccolo. I've served with Niccolo when he was a CEO and then chairman of the board of Glue, which we worked on together for about 10 years, maybe a little longer, which we sold to EA earlier this year, and then also as him being my client at his prior operating company. And when he got into this SPAC thing, and said he was going to do it, frankly, I didn't even know what it was, but still backed him. Probably like Bharat, wish I'd have backed him on more of them and more in each one. Niccolo is super creative, an amazing executor, and happy to have him as a friend and a friend of the firm. I see him spinning right now, so I'm not sure if he's showing up yet. Oh, I know he's here, but
I'm definitely here. I'm just hoping I don't return the favor with an intro like that for you, because I wouldn't know how to do it. No, I'm kidding, Ben. But
I also helped, most importantly, help Niccolo's children catch their first fish. That's probably the only reason he actually still hangs out with me. That's the biggest contribution I've made to his life.
No, that's true. Not the biggest crab or the first crab. We're still working on that.
Yep. So I'll just get this kicked off. Niccolo, why? After all the things you've done in your past career, why did you decide that this was the time to start thinking about approaching how you change businesses from a SPAC perspective versus a venture, hedge fund, operator? What drove you towards that SPAC was the opportunity now?
So I've been following the SPAC industry since 2007. Believe it or not, after I sold my first public company, I looked hard at doing one. At the time, it would have been with the chairman of Orange Telecom, Hans Snook, who had been the chairman of my business in the UK that I'd run before that. And the SPAC industry, frankly, even 3 years ago, let alone 13 years ago, was kind of a tier 2, tier 3, I'd say slightly dirty business. If I looked at the quality of the underwriters, the quality of SPAC sponsors, and the state of regulatory engagement. And so in 2007, it was a number of tiers, frankly, below even where it was 3 years ago. And I ultimately did not pull the trigger, although we got close. I embarked on an extended operating career that ended up taking me to Glue, in 2009 and 10, and here we are. I've always had my eye on the space. I never sort of stopped looking at it, and believe it or not, in 2017, I kind of re-engaged with the sector in a more formal way, and started working on what turned into DMY Technology One, which was a gaming-focused SPAC with my partner Harry Yu. Life is always about a mixture of sort of like luck meets, luck is preparation meets opportunity, right? So I feel like I've been preparing to be a SPAC sponsor for my entire career. If you look at the skill sets that we bring to bear, Harry and I are both public company CEOs and CFOs. We've done 21 or 22 public companies in total between us. If you look at what we've either been the chair of a comp committee of, on the board of, the CEO or the CFO of. And that makes us pretty unique. We are not, not recovering investment bankers. We're not recovering venture capitalists or private equity guys. What I think makes us sort of different is the fact that we're used to having spent our career making decisions and transacting and then carrying the bag 2 years later, on that, whether that acquisition makes sense, whether that secondary makes sense, whether or not that, IPO made sense, or was it priced right? And so we're very different animals from the perspective of being fundamentally long-term greedy. We are not the highest earning SPAC sponsors in the world, but we're getting the best results for shareholders. And I like to sort of think that it's the combined effort of, my almost 20 years in the public markets, and my partner's been at it for almost 40. And so we've got almost 60 years and hundreds of earnings calls that we've sort of sat on over the years in the CEO or CFO chair. And we really empathize and know what it's like to go through an IPO process. And we also have been refining the playbook, right? We've got pretty good pattern recognition. I made a lot of acquisitions at Glue that have been pretty good for the company. But between Harry and I, we've done maybe 150 acquisitions as public company leaders. And so we understand what will work, what won't work. And we've been through a lot of down cycles. I won't kid you. All the way back to Black Monday in 1987, Harry and I have been through all of the crashes, and we've been in the public markets through all the crashes. And so we're very comfortable operating in the public markets regardless of the climate. And so we didn't think the SPAC industry would grow to where it is today in 2018, 19, when we started working on DMY 1. We were still very much pioneers with DMY 1, which was my first SPAC, Harry's second. And there was only about 40 SPACs around in the world of that order, a few dozen in late 19, early 20. Today, there's of course 400, and that causes its own challenges, which I'm happy to elaborate on as much depth as we want. But obviously, in 2011, the regulatory framework changed, and so the vote decoupled a vote in favor of the transaction from a redemption vote. I think that you could probably plot a very gentle, sort of upswing from 2011 onwards, albeit from a low base. And things have obviously taken off.
Hey, Niccolo, for a lot of people, they probably don't know what those two decisions are. Could you explain those two votes?
Yeah, so look, the SPAC IPO process, I view it as the third mechanism for going public. So an S1 IPO is a traditional IPO. A direct listing is very fashionable, although very few companies have been able to pull off a pure direct listing. In fact, only two. Right? I think Spotify and Slack have managed or maybe one of the only 2 or 3 pure direct listings. The S4 process is what a SPAC is. It is a reverse merger. And so SPAC sponsors like myself go and raise our own S1 IPO, which is a blank check IPO. We then find a company that wants to reverse merge with us. And that reverse merger has a whole list of things that you vote for as shareholders in the SPAC. If you own a share in my blank check company, you have to vote on all sorts of things, from charter amendments through to whether or not you want the transaction to proceed, through to whether or not you want to keep your capital in the blank check company, even if the SPAC closes. And so the framework around those votes has evolved a lot in the past 10 years. And the investor base has broadened and deepened considerably. So there's been a virtuous circle operating for the past, I'd say last 3 years, but it's obviously accelerated the past 18 months, improving the quality of companies going public with SPACs, improving the quality of sponsors, and improving the quality of underwriters and investors in it, right? And we work with Goldman Sachs and everything we do. I give Goldman Sachs actually a lot of credit for this virtuous circle. They didn't used to do SPACs 3 or 4 years ago, but their approach was, hey, maybe we can change the dynamics of the space single-handedly if we hold a really high bar on the quality of sponsors. And then the quality of sponsors means you get better companies, and better companies means you get better investors, and away we go. And so Goldman used to only do 1 SPAC a quarter. We were that 1 SPAC a quarter on DMY 1. I think they're doing slightly more than 1 a quarter right now. And my hope of the space is that every underwriter with a franchise they care about goes back to doing one a quarter, because quality is important. And there are one too many SPACs in the ecosystem, and there's going to be a flight to quality that happens, either viciously or naturally, depending on how you view this. But investors are withholding capital from poor quality situations and teams, and underwriters are doing the same and will be doing the same shortly. So the space will go back to being maybe not 40, but I bet that the 440 goes back to, I don't know, 140 or something like that in the next 18 months, probably, is my prediction.
So
we have some questions for you.
Hold on a second, Bharat. So given your and Harry's background, you guys could have raised $1 billion fund and collected a lot of fees every year, and invested that $1 billion in the public and pipes and private companies, a lot of different options. Why did you choose SPAC, and is it more risky for you? What sort of drove that decision?
Yeah, no, that's a fair question. And look, I'm not ruling out the fund, the DY fund someday, but in the meantime, I think the SPAC IPO process is probably the purest expression of both my track record and my partner Harry's track record. So if you look at how we've created value in the public markets for 20, 40, 60 years in total, a lot of it has been combinatorial, right? As you saw firsthand, Ben, on the Glue board. I mean, I think that company was, when I started, there was a $30 million market cap, and later on, early 2010, and I think when we sold it, it was $2.4 billion, and it was a good journey for shareholders and hopefully a good journey for board members. But I think it's not an exaggeration to say that somewhere between 97 and 99.999% of the revenue that we ended up selling was something that we acquired right along the way. I'm not saying we didn't add value to those acquisitions. That's a really important part of any playbook. But if you looked at kind of my track record and Harry's, we probably have done similar stuff in different sectors and different scales. I mean, I'm a sub $10 billion market cap entrepreneur, and my partner Harry is really a $100 billion market cap, operator. But he made a lot of acquisitions at EMC as well, and so I think both of us got along well. It's a good partnership, good marriage, whatever you want to call it, and we're able to spend our time doing exactly what we're really good at, which is having an impact in the public markets for companies in the size range that I've been particularly focused on, kind of 1.5 to kind of $3, $4, $5 billion market cap companies. And so we enjoy working with, entrepreneurs at that stage in their life cycle. We're not working with startups. We're working with companies that are capable of doing their own traditional IPO, probably 1 or 2 years down the road. But with our sponsorship and our capital, we kind of get them there a bit early. And it gives us a chance to create new sectors, admittedly. I mean, we did the world's first quantum computing company. We've done the world's largest satellite data company. We've done the US's first online casino and first online, sports betting data company. And so we're pioneering, but we're pioneering as kind of public company entrepreneurs. And I think we sort of would define ourselves as public company entrepreneurs. And so at the end of the day, it's a little niche-y in the sense that we're not early stage investors. We're not leveraged buyout people. But if you are an entrepreneur who believes that an IPO is a step in building your 10 or $50 billion market cap company, as opposed to it being the final step in an exit process, we're great partners for you. And if you're looking for an exit or a trade sale, we're not going to be the right partners for you because that's not the business we're in.
Cool. Bharat?
Sure. Snehit, can you unmute Ankit? Ankur. Ankur, please go ahead. While we are waiting for him to be unmuted, there's another question, Niccolo. Why is it that the tech companies seem to have gravitated towards SPAC? What's so special about tech companies itself?
So I think what SPAC sponsorship, and I really refer to the highest quality SPAC sponsorship. So there's about 10 companies. You guys have the slide. You're welcome to throw it up if you want. But there's about 10 companies in the world that dominate post-close performance. We fortunately are at the top of that league table right now, but there's other names you'll have heard of on that page who have delivered returns for investors repeatedly. And we've been able to demonstrate and the sort of top tier of SPAC sponsors that we can do things a traditional IPO or a trade sale cannot achieve. So SPAC sponsorship with quality board members and a quality investor following can get you, earlier to the public markets. It can get a situation that might be more complex into the public markets. And of course, it demonstrated in the past year or two that there is appetite for growth stage companies. And by growth, I fundamentally mean earlier stage than what you've seen S1 and direct listings be receptive to for, I would say, the better part of a decade, right? So if you scroll the clock back on the public markets, and people forgot this for a long time, but in the 1970s and 80s, there were early stage growth companies like Apple and Microsoft that were pulling off IPOs in 1978, 1981, 82, 83. And these companies were IPOing to raise money to grow. Believe it or not, that was the playbook. Apple was like a $600 million market cap business IPO, and it raised money to grow. And people expected them to spend that money to grow. Somewhere after the dot-com boom and the sort of Great Recession, public market investors kind of lost sight of that, in my opinion, to some extent. And it turned into like, stay private until you're bigger, more mature. We want predictable earnings only. We're only going to underwrite, retail, oil and gas, leveraged buyout, fixed roll-up strategies of banks, and so that investing capital, I think, moved in the direction of some large private equity firms that have grown funds under management to astonishing levels. If you're a Blackstone or a SoftBank, I am delighted to see that in the past 2 to 3 years, and really the last 2 years, public market interest in growth stage companies has begun to grow again. And it's begun to grow again, in my opinion, because these things have long super cycles to them. The number of public companies in the United States shrank a long way before this upswing began. So we went from 6, 7, 8, 9,000 public companies, 15 years ago, 20 years ago, all the way down to about 3,000, I think, 3 or 4 years ago. And now, we're back to about 6,000, right? So, my suspicion is there is room for another 1 or 2 or 3,000 public companies, but after that, things will get smaller, capital will get a lot more expensive. It already has in a lot of ways, and people will have higher expectations of companies going public. But I hope that public company investors don't ever again lose sight of the fact that there is room in the public markets for themes like the world's first quantum computing company. If you're Fidelity, you have no way of accessing exposure to that if you don't want to back a business like IonQ that we just closed last week. If you want to wait 10 years for them to be a much bigger business, you can do that, and that's what was happening. But fundamentally, I think that public markets have room for this. There's appetite for this, and it will remain the case that there will be public appetite from mature to growth in tech markets as well as established markets. And at the end of the day, Bharat, to answer your question, the tech industry consumes the largest category of market cap in the United States, bar none, right? I mean, it's a 30-40% of market cap is classed as technology. I think healthcare is, a fifth of that kind of thing, right? And same in almost all other sectors. They're generally smaller. And the reason why it consumes that share of, both GDP and value creation is, as a friend of mine once put it 20 years ago, if we're not going to make money as a country or an economy by investing in tech, what are we going to make money in? It's like you can't really invest in Carnegie Steel in 2000 and expect the same returns you had in 1900. And people forget, time and time again, I'm always reminded of the fact that people like Carnegie made their money, and same with Rockefeller, by being the tech entrepreneurs of the time. The Bessemer Trust today was founded by a gentleman who sold his business to Carnegie, and he named it after the Bessemer process that was a cutting edge tech thing in the 19th century, right? And so I have a lot of respect for things like people like the Bessemer Trust and the Pfister family behind it, who realized 100 years ago that if you wanted to grow your family's wealth, you have to keep investing in technology because every generation will grow vast wealth in technology. And that's here to stay. What the technology is, we can debate, but technology is here to stay.
Thank you, Niccolo. Hey, on this, we have two questions from the audience, one from Ankur, one from Chris. I think both of them should be unmute. Ankur, why don't you go and then we'll take Chris.
Yeah, so thank you for doing this. Great session. I wanted to check on from the investor point of view, like how is this different from say investing in a VC or an angel, and what is the like investment horizon we are looking at, and also a minimum ticket size?
Yeah, so there's a number of misconceptions around the SPAC market. It is not distinct from the public markets. It is a different mechanism for becoming a public company. But you end up, if you're on that league table you're just showing, everyone on that league table has an investor base that 1 to 2 earnings calls after you close with one of those 10 or 12, you end up with the same shareholder base you would have regardless of whether or not you did an S1 listing, a direct listing, or an S4. It is true that I would say sentiment got ahead of itself 6 months ago, and there were people buying anything that had the word SPAC in it at any price because there seemed to be always somebody else willing to pay more. And that was as true for institutions as retail, okay? There are institutional investors licking their wounds right now, some really big ones that threw tens of billions of dollars into the SPAC market between, say, November and February last year and this year. And guess what? They're now selling anything they own that has the word SPAC in it indiscriminately, just like they bought it indiscriminately. I think that's foolish, right? There are high quality assets, including ours, in the SPAC, IPO, de-SPAC, and post-SPAC process that perform very well and that will continue performing very well because someone like DMY Technology focuses on fundamental core outperformance, right? So our companies all upgrade their earnings calls time and time again. I think I gave you guys a slide for that too, which you're welcome to put up at any time. And we pride ourselves on not just meeting guidance, but beating guidance, right? If you take a long-term fundamental approach and you can beat your numbers quarter after quarter, you're going to be a great public company. And the opposite is also true. So if you put out forecasts that it turns out you have to miss repeatedly in your first year, people are going to really remember that and probably loathe you, both in the institutional and the retail space. And frankly, you deserve to perform badly if you put numbers out you can't hit. It is a cardinal sin for any public company CEO or CFO to put out projections that you can't just meet, but hopefully you're able to beat. So our investors, just to answer your question, are Fidelity and T. Rowe Price and Wellington, and they're generally long-term, fundamental driven public investors. We have slightly different shareholders coming into the SPAC at different stages, but all of them are clear that we're driving towards a quality long-term public company. I'm not saying that there aren't, some shorter horizon investors that are in every IPO, but I will point out that traditional IPOs, particularly in the sectors that we're in, technology, game companies, and so on, they used to be driven entirely by hedge funds, even with an S1 or a direct listing IPO. There were a lot of guys and gals buying it for the pop. And so I would say that for a quality SPAC sponsor with a quality company, we look the same as an S1 IPO or direct listing. I'm not saying that's all the SPACs in the market, because there are always tier 2 and tier 3 everything, as there are tier 2 and tier 3 S1 IPOs from underwriters you've barely heard of. But for a Goldman Sachs IPO or a Morgan Stanley IPO, it's the same ECM team that is taking us on the roadshow, regardless of which one of these processes ultimately, okay? And so we are absolutely a different pocket of capital from private angel investors or private venture capital or private equity players. Our investors are usually not locked up for long periods of time, usually, not always. Some of our investors do accept lock-ins anywhere from 6 months to 18 months, but that's usually strategic investors and family offices, not Fidelity, I would say. We look for long-term, fundamentally driven institutions because we want people to be taking the same time horizon that we do. And so Harry, Niccolo, and DMY Technology are very focused on the years, making sure the first year goes well, making sure the second year goes well. We, of course, want to guide responsibly, and so we want the quarters to go well building up to that. But we are locked in as SPAC sponsors for 12 months most of the time, sometimes as much as 18. Sometimes if we perform very well and the stock doubles, we might be unlocked in less time than 12 months, or at least on a portion of our holding. But in general, we're in that kind of 12, 18, 24 month bias because, by the way, just because we're unlocked doesn't mean we're not in the stock. It's like if we get unlocked 18 months out, which is kind of where we are in our fourth SPAC IPO, which is not closed. It's been announced, but it's closing towards the end of this year. We're locked up for 18 months. And so we won't even begin to be able to sell our positions until month 21 or 24 or whatever, because ultimately we'll be insiders and on the board and so on as well. So yeah, we're in that 1-2 year public company hold, and we're purely public market investors. So if your company is public company viable, we're an investor. If you're not public company viable because you're too early or there's something else going on, we wouldn't be an investor.
Thank you, Niccolo. We have another question from Chris, mostly focused around milestones and what investors should be looking on. Chris, go ahead with your question, please.
I can just keep.
I'll read the question. What are the milestones, bookings, or technical that investors should be focused on?
I get a lot of questions from our illustrious retail investors, and I have a lot of respect for retail investors who are doing their homework and taking a fundamental perspective. That's what we encourage. Every company is different, but in general, you want to be looking for management teams to do what they say they're going to do. So the say-do ratio, I think, is important for every company, but it's particularly important in how you set milestones for a public company. I'm not going to kid you. Revenue is one of the easier things to follow, obviously. Every company that we take public has revenue, including the quantum computing business that is almost a year ahead of monetizing relative to forecast 6 months ago when we raised the pipe and did the initial roadshow. Every business will have different metrics that underpin revenue performance, and every business will have a different trajectory of profitability. But all of our companies have probably double the capital they need, in some cases triple, to reach a sustainable profitability perspective. It's one of the things that we look for in our own diligence and underwriting process, is making sure that the money that we can deliver is kind of 2x, if not more, what you need to ensure that you're fully funded regardless of what happens in the business cycle, and to make sure you have some additional money for acquisitions, acqui-hires, key hires, partnerships, et cetera, and frankly, cushion, as well. I can go through each one of the deals if you want, but in general, we're following revenue and the metrics that drive the revenue as the headline. And then there are obviously technical milestones, product launches, and partnerships in the case of our first two SPACs. Partnerships and legal liberalization of sports betting and gambling in the United States, state by state, are big drivers of our first two SPACs. Technical milestones matter on our third and fourth, but I always like to remind people that the best technical milestone is revenue delivery, right? Because revenue delivery means not only did the product work and you hit the technical milestone, but it also means that people cared. And people caring about what you're selling or offering or that milestone, I think is the purest way of any general investor to understand whether this stock is performing and management doing what they're doing without having to have in-depth technical knowledge yourself to be quote unquote smart enough to be an investor. And so our job and every public company's job, in my opinion, is to make sure that we are distilling the story down to simple metrics that anyone can follow. And revenue delivery, top of my list generally. Understanding, the key metrics underneath that matter. But as I always remind people, I've had a number of people tell me over the last 6 months that, quantum computing sounds, like they don't understand it. And I sort of said, trust me, NVIDIA, you didn't understand either when it IPO'd at about $1.5 billion market cap in 2001. And I assure you that 99% of people that invested in Intel in the past 50 years did not understand all the engineering that was going on there either, or that goes on to this day, right? And so every one of these companies you can follow with revenue guidance, meeting and beating and financial metrics before you have to double click on user numbers, technical milestones, monetization metrics, et cetera, et cetera. Research analysts will cover that for you. And we partner with research analysts on each of our companies to make sure that if you want to read a 50-page in-depth initiation report, you can do that and you'll get the next 2 or 3 levels of granularity beneath the headline figures.
Niccolo, why do they fail? I'm not going to ask you to name some of the most spectacular failures in SPACs in the last year, but why?
They fail predominantly for the same reason that any public company fails. No joke. So let's remember, there were great companies like WorldCom and Enron that I believe a former president and vice president once lauded as the greatest company in America, right? And it turns out that not everything they did was ideal from a long-term perspective. There have been a few SPAC sponsors that have done something similar in my opinion. And so let me pick some examples. If your forecasts are not something you're going to meet and beat, but they're a hope and a prayer, it's going to end badly. That's the case for S1 listings, direct listings. I mean, if you come out as a CEO, regardless of the IPO, and you miss your first quarter's earnings, you deserve everything you got coming at you. And that happens regardless of the IPO mechanism. S4 IPOs are just one option. If you are a SPAC sponsor and you market a pipe with numbers that you decide you can't make when you come to the votes that we talked about half an hour ago, you deserve everything you got coming at you. Of course, people are not going to vote in favor of keeping their money with you if you basically, I'm not going to say lied, but if you put numbers down that were not just not conservative, but, were a stretch, okay? Other things that any public company should not do, whether you're a SPAC or an S1, S4, you should make sure the capital you raise when you go public is more than enough to be sustainably operating. If you go out with a business plan that says, I can hit this revenue number in 3 years, but then you decide a quarter or two after you do your IPO that you don't have enough money to do that, it's kind of the same as my comments a minute and a half ago about your forecast generally. You need to make sure you have enough cash to deliver the forecast. Otherwise, you're fundamentally not representing something, in my opinion, holistically and accurately. So those are the primary reasons why things haven't worked out.
Why do some SPACs just never get a deal done?
So some SPACs run out of time because, frankly, they, I'm not going to say don't know what they're doing, but like with everything in life, there are people that have done it more times and have experience, and often there's people that are learning on the job, right? And so I always recommend, if you're a company that's talking to SPAC sponsors, I highly recommend that you talk to people that have done this a number of times before. I am a much better, more experienced SPAC sponsor on DMY 6 than I was on DMY 1. That's just a fact. I'm way better. I have way better tips and tricks, tactics, strategies. My investor base has a huge amount of trust in me now that whilst the first time they'd heard of me because I'd made money and other things, I hadn't done it exactly in this vehicle, right? So our money stays, right? In Q3 this year, the average redemption percentage for a SPAC transaction closed was 52%, according to Deal Logic. We closed IonQ with 2.5% redemptions, right? Ended up with $635 million instead of, I think, 650 of a theoretical maximum. That's pretty darn good. In fact, it's remarkable. It's the lowest percentage in the quarter. And it's one of the reasons why we're at the top of that league table. So we are demanding, Ben, as a team, we won't underwrite a whole heck of a lot of stuff because we are long-term greedy and because we know that ultimately our long-term adjudicators of both our success, our company's success, are institutional investors. It's making money for Fidelity long-term. It's making money for T. Rowe. It's doing the right thing at all moments for them to make sure that when we put forecasts out there, we hit them and beat them, and making sure that we do it repeatedly with the right momentum, the right trajectory. If you take a different approach, so if you're in this just to get any deal done, you don't care, you're probably not going to have an investor base that's there for you in the long term. And then there's a whole crew of people, by the way, Ben, who honestly have never run a public company, are approaching the SPAC industry like an M&A banker. And I can tell you that if your strategy is to win a transaction by paying the most, turns out that those Fidelity people probably won't like that very much down the line, right? If you pay more than fair market value, most people are going to redeem, right, when you come out for a vote. So there's many opportunities for failure in the SPAC IPO process for a sponsor. There's only really one way in my mind to succeed sustainably and repeatedly. And that's, operating with long-term integrity, making sure that at all times you're focused on long-term returns and underpinning the long-term returns with fundamental outperformance. And I preach this to everybody, not just on this call, but all of the underwriters in the space, all of the accountants and attorneys, withhold your services and capital. I ask every institution who invests in us, and we had our second most oversubscribed IPO ever just on Friday with DMY6 because of our track record. I ask everyone who invests in us to please withhold your capital from people that are taking different approaches, because it is not good for the sector, the underwriters, the banks, the lawyers, the accountants to take a different approach. It's just not.
And
Thank you.
maybe
Go ahead, Brock.
A little bit of a different angle, as Niccolo was talking about. So we understand there is a role for bankers, investors, people with funds. What's the role of a firm like Carney, or the role that you play in these SPACs?
So, I mean, I will tell you that
you answer that one, and then I'll answer my bit, Ben. But I hope
a year ago, the first time
I'm praying that AT Carney is not going to start underwriting their own IPOs or get into the SPAC sponsor business. I'm praying that.
Nor is AT Carney filing for a SPAC. But a year ago, the first time one of these came, we have a big private equity M&A team. A lot of that focuses on the sort of mega private equity firms, where we do a lot of work. And a year ago, the first time one of these came up, frankly, a lot of us are like, what is this? And over time, what we found is we've had a number of requests, just like we do on a sell side or buy side diligence. We opened up where a lot of people are asking us to do, SPAC sponsors are asking us to do buy side diligence. Either it's market diligence, but some of these markets are early. So what is the market for XYZ technology going to be like in 5 years? Or because these companies are further along than your average startup, how is this company operating? What are the opportunities for this company to operate differently? What does the M&A pipeline realistically look like for the new asset? And I'll be honest with you, just like Niccolo said, the first time we did one of these things, we probably didn't know what we were doing. We've slowly figured out more and more and improved our own, sort of toolkit and thinking of what's different than a private equity buy side in doing one of these.
No, that's well said, and Ben also knows that DMY has definitely engaged the services of a top tier consulting franchise for exactly that kind of work. It is something on the bullish side for Carney's practice on that. It is something that the top tier underwriters increasingly almost require / demand.
Yep.
So a Goldman Sachs
and what we found is a lot of the big private equity firms have decided that this SPAC thing is something they should be doing too. I'm not, and so we sort of got pulled into it by our large private equity partners who we work with on this stuff all the time, and their perspective was, I don't understand why you guys are confused. It's the same thing you do for me normally, except for you're doing it and something that we're doing a SPAC on.
And that's mostly true. I assume that your playbook will become more sophisticated and refined as you do more of these, because there is definitely a slightly different, trajectory and sort of, let's say, metrics that are going to matter to public investors when you're trying to simplify a story than are going to matter to, a private only play. So I expect that will continue. And I believe that, a top tier underwriter like at Goldman Sachs is focused on staying one step or two ahead of where the SEC is. So, DMY Technology and Goldman Sachs have always been best of breed from a sort of compliance and diligence and regulatory framework, because we always want to be the people leading, not the people getting asked by the SEC to do stuff in general. And I would say on that front, honestly, it's converged almost fully. Okay, so there were moments 2 years ago where you could kind of get away with, the CFO's new but hasn't arrived or is arriving. Today we can't even announce, we won't even announce a deal at DMY, let alone close a deal, without a great CFO's feet under the table and the audit's all done, et cetera, et cetera, et cetera. The role of the SPAC sponsor, to answer your question, very, very simply, and I'll save time on this one. My job, our job at DMY is to make sure the ecosystem, our ecosystem, has a good experience. So whether or not you are an investor in our IPOs, the DMY IPOs, or you're an investor once we announce a deal in the pipe, or you buy the stock in the aftermarket before we announce a deal, or you buy the stock in the aftermarket after we announce a deal, or you invest in the stock after the IPO closes and you buy in the aftermarket, or you invest in a secondary that we do, like we did in our second SPAC, after we close. Our job is to make sure everyone has a good experience. Are we flawless? Probably nobody is, but so far the batting average is pretty good, as long as you're willing to hold the stock for months, not hours. Right? We are not focused on driving any of our companies for day traders. We're focused on making sure that quarter in, quarter out, year in, year out, we do well. And so if you're patient with us, you will get the 70, 80, 90% 1 year returns you're getting for DMY 1 and 2. And I expect you'll get the same from DMY 3, 4, and 5, and 6. If you're in it, instead of being patient for a year and you're in it for 12 days, you're taking your own risks, because our companies are not run for that. And while I'm actually touching on that, part of my job, Bharat, is to make sure that the management teams have a good experience. It's not just fidelity and invest along the way, but it's making sure the management teams have a, I'm not going to say entirely always fully enjoyable, but a successful first year as a public company, of making sure that they set themselves up, guide properly, do their earnings calls properly. It's a lot of work. I think they can get a lot of satisfaction out of what they've achieved in working with us, but we're quite demanding as board members and SPAC sponsors of what we, kind of kindly request our teams do. It gets results, but again, not every company wants to do everything that we think is important for having a successful first year. If you do everything that we request of you, we think the first year is going to go well. If the first year goes well, the correlation between a first year share price performance and year 2, year 3, year 5, it's very high in the public markets. It's 90%-ish if you look at the history of public markets. And so we're very focused on making sure before the IPO happens, you know what you're doing, and the first year, you know what you're doing, and it goes well.
Niccolo, we have a lot of questions, so we'll have to do a little rapid fire. And I know Ben has some on his plate too. So first question, we know you know about SPACs. Let's see how much geography do you know. Padma Priya is going to ask you a question. Padma, the mic should be open for you.
Really. My question is regarding SPAC, the scope of SPACs in India. We haven't had SPACs in India so far, but there are a lot of technology IPOs that are happening recently. And what is the scope of SPACs in India? And if there is a scope, in what sector do you see it happening?
Okay, so I might have not caught all of that, but I think your question was on SPAC IPOs for technology companies in India. Did I hear that?
The scope of SPAC in India, basically.
Yeah, so there have been a number of SPAC IPOs, blank checks raised by sponsors with strong, track records and heritage from Indian subcontinent. There have been a number of transactions announced with companies that are fully domestic, onshore Indian businesses. And this is not just this year. I mean, going back almost a decade. In fact, and now, do they all do well? No. Why have they not always gone well? Part of it has been a mismatch, I think, in public company readiness. Part of it had been challenges on things like bureaucracy, getting cash dividends to American investors, all that kind of usual thing that you get with international IPOs. Part of it has been, I'd say that some of the highest quality companies have tended to remain private and then gone to do, formal IPOs, traditional IPOs with investors that demanded that. But I'd say that I'm long-term bullish on Indian transactions and IPOs. We get people that suggest we look at these frequently. I do think that the regulatory framework domestically, is not flawless. I think the attitude of some entrepreneurs domestically at times has seemed to be a bit more in that category of this is an exit as opposed to a next step. And so as you get more entrepreneurial maturity around what I want to do with my life in the next 10 years is not exit, but run a successful company listed on the NASDAQ or the NYSE, I think you're going to see a big pipeline of quality companies coming this way, particularly now that you've got a kind of platinum venture ecosystem and a platinum corporate venture ecosystem. I mean, some of, if not all of the biggest Indian TMT deals have been a SoftBank, a Sequoia, a Walmart, an Amazon, sort of coming into the country at a level of capital that is far larger than anything that a SPAC team such as ourselves could generate also.
Thank you, Niccolo. Albert, go ahead with your question. Niccolo, Albert has a question on the size of the pie. Albert?
Thanks for organizing this. This is very helpful. I've noticed that a lot of the pipes in recent SPAC deals have gotten like way bigger than the SPAC trust account itself. And I was wondering, like, how does that inform like your search process? Because I feel like in the past you could have searched for companies that, maybe were looking for equivalent to what the SPAC trust account was to raise. But now the pipe being so large, how does that universe work? And also, are these pipe sizes being so large sustainable, or do you think it'll just replace the SPACs altogether? Thank you.
That's a good question. And look, no one knows the exact answer to that. What I will say is pipes are getting larger because two things. One, there's a class of long-term investors like Capital Research that has a mandate that disallows them from investing in blank check companies currently. They will invest in a pipe, but they won't invest in the IPO. And everybody wants Capital Group or Fidelity or T. Rowe Wellington, on their shareholder roster, or BlackRock, given the opportunity. Okay, that's sort of one category of opportunity. The second thing that's going on is it's important signaling. So getting quality people into a pipe and getting sticky capital into a pipe. I mean, we've had, in our deals, we've had Mark Benioff, Bill Gates, Michael Dell, these sorts of people have also invested in our pipes. And, it's a positive validator of any company, right? If you can get successful tech entrepreneurs of that caliber to say, I will buy this at $10 a share, in the pipe once I know what the company is. And there's also other strategics that we've gotten into our pipes. I mean, we've had companies and partners of our firms like, a Hyundai, for example, or a Samsung, for example, investing in some of our businesses and, getting pipe capital raised from people who are not here, even with a 12-month horizon, but are taking a 12-year horizon and want to help a company be successful along the way can be really useful. Lastly, I will say that there is a category of both market dynamics and in some cases SPAC sponsors and teams where they don't think there's a high probability that the capital in their trust is going to stay. And if you don't think the capital in your trust is going to stay, the only money that's going to be there when the deal closes is the pipe. And so pipes are getting bigger for that reason also. There are situations this quarter when I told you 20 minutes ago that the average, according to Deal Logic, average redemption for a close in Q3 was 52% and we were at 2%. Well, guess what? That's the average. There are people with 70, 90% redemptions closing in Q3. And there are companies that don't have business plans that are funded if most of the capital in the trust is not there. So they're having to go out and raise, in some cases, debt, convertibles, mezzanine financing, different backstop situations in the quasi-pipe capital structure to make sure that that company has a hopefully fully funded business plan.
Thanks, Niccolo. We have another question before I go to one of our participants. How does SPAC fuel growth? And what industries apart from tech are suited for that?
Your question is how does SPACs fuel growth? Is that what you said?
Correct.
Yeah, I mean, SPACs don't fuel growth. Public markets fuel growth, in my opinion, right? So public capital can be stickier. It can be cheaper than private market capital, obviously. It's fair to say that a Fidelity has a lower discount rate than a KKR probably, or even a growth stage venture investor in terms of what the IRRs are they need to be successful. And they also provide access for retail investors that can love a business and provide a lot of support in some cases. Being public is a strategic decision. And this is something that I can go on about for hours, but I'll try and condense it to 1 minute, which is nobody should go public because it's an alternative to a trade sale. You should go public because you want to build an enduring corporation that wants to have opportunities to attract and retain talent that they don't have with private company stock options. Liquid RSUs are useful in attracting some of the world's greatest talent for your company. And liquid stock is useful, obviously, for making acquisitions. You'll have more people willing to accept public paper than private paper for consideration. Lastly, I will say that if you want to be an enduring corporation, public markets allow you to raise capital more often in more ways with more structures, more of the time than any other opportunity you have. You can take any kind of debt, mezzanine, preference shares. You can do almost anything you can think of in the public markets. And the public markets are almost always open on the right terms, whereas private markets can shut. And so these are the reasons to go public, right? So public markets fuel long-term growth. Let me put it this way. The very biggest, most valuable companies in the world are all listed, including even Saudi Arabia's, sovereign oil company is now a public company, right? And so you're really hard pressed to find in any industry the top 3 companies not being public businesses because of the stickiness of capital, the lower discount rate, the long-term perspective, and the advantages and the credibility advantages of being public, right? There is always some holdouts here and there, but in the long run, if you look at the long arc of history, even large family-owned businesses end up often being acquired by public companies in the fashion industry, in the food business, et cetera, even after long periods of being private. So we give you the capital to grow, we give you the currency to grow. That's the short answer to how you fuel growth.
Niccolo, we have a question from one of our participants, Megan. Megan, your mic is open. Go ahead, please.
Thanks, Bharat. Hello, Nicola. Thank you for being here. This is very enlightening. My question is I'm just curious, how often is a sizable acquisition part of the SPAC game plan in that first year? And I'm also really impressed by 90% of Glue's value came from acquisitions, because I've often heard that most acquisitions fail. And if you're willing to disclose, would love to hear a little bit about your secret sauce.
Yeah, within reason on all secret sauces, Look, there's a great book I encourage everyone to always read called The Death of the Media Mogul. If you haven't read that, I highly recommend it. It's a great book on why 75% of acquisitions for the acquirer in the media and technology space destroy value. And you're right, they normally do. And the reason they normally do is people overpay. People just get sucked into the competitive dynamic and say they want to win and they want an empire build and they have to have it. And frankly, everyone around the CEO of a public company that is consulting and feeding off the deal generally doesn't get paid if the deal doesn't happen, much like a realtor. So guess what? Like, realtors want to sell houses, right? And so guess what? Realtors list their own houses at higher prices in the same neighborhood than they recommend their clients to do, right? That's just a statistical fact. They will stay on the market longer at a higher price because it's their own house and they'll recommend you to sell because they're getting their 6 or 7% commission. It's the same in public market and all M&A. Every banker involved in the deal wants you to do the deal, even though they say they won't, they generally do. And a lot of the transactional partners around that may or may not have success fees, okay? And people have egos, right? And people want empire build. I try to take the opposite approach, right? So, you know, at Glue, we look for asymmetric risk situations every time. Asymmetric risk, right? We're buying a business that's breaking even. We're not overpaying for it. But if some of the new products work, it could be explosive upside. Turns out over a 10-year period of time, that is a pretty good risk profile to take if you do it over and over again. And by the way, in general, that's going to be a true statement in every industry. And if you do the opposite will be true. If you overpay for existing businesses that don't have a good pipeline, you're probably going to be licking your wounds. For our SPAC franchises in general, you know, we are looking for sectors and deals that have combinatorial opportunities, consolidation opportunities. It's one of the reasons to go public. But at the same time, we haven't done anything transformational. We've done a couple tuck-in acquisitions at our second SPAC, Genius Sports. Our first company did an acqui-hire. Our third has announced no acquisitions. Our fourth will make some acquisitions, but they'll be probably in the on the smaller side and sort of in the acqui-hire category to fill in and accelerate roadmaps. And so there have been transactions, just to finish off that question. There are SPAC deals where two things come together. Some great deals like DraftKings, you know, was a big company making a significant but not transformational acquisition. And my partner, Harry Yu, holds the world record for doing something which we will never attempt again, which is in his first SPAC before we partnered up, he brought 6 companies together in a single SPAC transaction with Citibank in 2016 or 17. You know, that's very hard to do in one deal, almost unnecessarily difficult, I would argue. And so I think you'll continue to see SPAC sponsors IPO one business or at most 2 is my prediction. Once you close, like every IPO business, you are free to operate as you would like, and you're free to continue making acquisitions. I think we're at time here. So
I have a laundry list of questions, and I think they just keep coming. But I guess we have to say thank you.
Yeah, I mean, look, let's do it again, ladies and gentlemen. I'm happy to do another hour anytime. It's been a pleasure, and I appreciate the moderation. I appreciate the quality of the questions, and I'm sure we could go another hour or two. So maybe this becomes a quarterly SPAC seminar. You never know.
Niccolo, I really appreciate your time. And maybe we'll do one in the future on one of the spaces you're deep in. I'd love to see one done on quantum computing with maybe your team who's working on that. Because that's something that a lot of people are interested in our space in the communications, media, and technology. Thank you.
Looking forward to it. Have a great day, guys. Take care.
Bye.
Thank you, everyone. Thank you for joining.